Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello, and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Alphabet ahead of their earnings announcement. Today, we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at an advanced trade using options in Alphabet, well, otherwise known as Google. I'm highlighting the trade or the strategy that we did on Tuesday's show, a little bit more advanced than we normally talk about on the Stock Play of the Day. But we looked at doing a skip strike butterfly. Other people have called this a modified butterfly or a broken wing butterfly. But the concept is that it's an alternative to selling a short spread outright. Now, a lot has happened in this week. Very rarely do we go this advanced, but we had two of the biggest Fangs stocks announcing earnings this week. We had Google that announced after the close on Tuesday. And then on Thursday, we had Amazon announcing after the close. And here we are on Friday. Also, Facebook announced this week, and they didn't do too well overall. They brought all of the NASDAQ down. Facebook at one point in time after their announcement was down over 25% total. As far as the stock was concerned. Google had a real good announcement, and they also announced a 20-for-1 stock split. So overall, the story about Google was more about the stock split announcement. They did have very solid numbers overall. And we're going to start this week. We're going to get a little bit long-winded because we're going to go a little bit into the strategy and the concept that was behind it. And then we're going to discuss how I would have adjusted the trade. Because on the opening, it was a very scary trade. And we highlighted this on Tuesday's show that there was one situation that would really hurt us on this trade. And that's if it gapped a lot more on the open than the expected move. And because of the stock split announcement, we did get that gap. So how would I traded that? How would I have adjusted that trade overall is what we're going to talk about. But if you just fell asleep and you woke up in the afternoon on Wednesday, the day after they announced their earnings, well, you would have been fine. You could have got out of the trade at a profit to the account. So let's start by going through the strategy, and then we're going to look at the chart. Okay, here's what a skip strike butterfly is. Now, on a lot of people that are looking at high volatile situations, they like to sell what's called a short spread. So if you're selling a short spread, which I'm showing here inside the options playbook, it's a short call spread. You are trying to capture premium. You're trying to capture implied volatility. You want time decay. Around earnings, short spreads, you can go way out of the money relative to normal times and still bring in a decent net credit to the account. The downside is, and you can see this from the profit and loss graph inside the playbook, is that you're bringing in a small net credit to the account. That's the maximum that you can make. And that's all done by selling strike A, and that's a call option. We're way out of the money. Remember, underlying stock is all the way down in this range. And then you're buying protection, saying, well, if it does shoot all the way up, I don't want to lose unlimited and then be just short a call because that is a possible scenario. So we spend some of that credit to pay for some protection and limit our risk on the upside. Now, the downside of this trade is that you have to do, if you lose on the maximum on just one of the trades, you're going to have to sell a lot of short spreads. And ideally, if you're doing this around an earnings play, to try to make up for it because you have a high probability of success, but you only make a little and you risk a lot. Okay, so when we combine a short spread with a butterfly, which here is a long call butterfly, our goal here is that we're going to sell something, a short spread, to pay for something else, to pay for the butterfly. Now, the butterfly then gives us a hedge. It gives us some protection. Obviously, the butterfly costs money, but in high volatile environments, butterflies become cheap. Why? Because you sell two at the money option contracts to try to pay for your wings, strike A and strike C. So a lot of premium makes butterflies cheaper overall. So high priced underlying stock like Google, high implied volatility that is created by the earnings, and butterflies become cheap. Hence, a lot of times you have the ability to combine those two trades. And I like to say we're skipping the strike. If we did a normal butterfly, it would be A, B, C, right? If we go back here, A, B, C, you do the skip strike, you skip C and you buy D. When you do that, you basically embed this credit spread into your trade. I said a little bit more advanced than normal for our stock play of the day, but it makes a very interesting profit and loss graph. We don't have as much of a credit to bring in, and that's highlighted on this side of the graph, just like in the short spread, right? If you notice, this is a lot bigger distance from the stock price or from on the profit and loss graph from the zero line on up because you're bringing in more of a credit. But now we're going to spend some of that. We're going to buy the butterfly, and we don't have quite as big of a credit. But at expiration, we have a hedge in that if the market starts going towards our short strike of our butterfly, well, that's okay. And it's all about the timing. It's all about how fast does that move against your position overall. So we had a great example this week in that Google surprised the market with the stock split information. The market rocked because of it. We moved 1.5 times the expected move. The expected move was about 150 points. And we went well over 200 up on Google before it was all said and done. So about a 5% move, got close to, almost a 10% move in Google at one point in time. So let's get to the chart and let's talk about how I would have traded this overall. Now, once again, nothing's meant to be a recommendation. We're just supposed to learn here. But ideally, the way I would have traded it would have hurt the position worse than if you just let it ride. Because right now that trade is profitable, and it's been profitable quite a bit since Wednesday, the open on Wednesday to right now. Okay, so here, this is actually the Ally Invest option change. Google is down again today, down 22 cents, $22. It was down a little bit yesterday. So the market rose well up over 3,000 the day after earnings. And here's the stock chart that's showing it. I'm showing you a 5-day, 15-minute chart. We always tape the stock play of the day on Tuesday live at noon Eastern time. So we're always dealing with live markets. Never quite know exactly what's going to happen overall while we're doing the show. But this is noon Eastern time on Tuesday. So the stock really didn't do much, which has a tendency to happen before an earnings announcement. Just kind of waiting to see exactly what's going to go on with the earnings announcement. And then here's the huge jump up. So on the open, we're looking at about 330. I'm going to round off here. And at that point in time on our butterfly, we are hurting on that position. So our long butterfly, and I apologize for that, our long butterfly trade that we have, we would have been way off on that trade because of the huge gap open. And now here's what I'm going to emphasize is that we wanted the underlying to go to 29.15. That's the ideal situation. So you would have panicked on the open. If you would have ignored it and ignored what I said on the Tuesday show, that if it does open up, you want to get out fairly quickly. The market actually came all the way down. And you see here during the day, there were 2 times where the underlying actually came down to our short strike, that 215 strike, 29.15 strike, which is where we wanted the market to be. And then as the week went on, it came down, and this is all day after the announcement, all day Wednesday, came close to it on the close, all day Thursday, and now here we are Friday. But on Thursday, it just hung out right at our short strike. So in general, that is what you want to happen. We just didn't want to have this huge gap opening right on the open. All right, so let's go and look at the trade, and I'll talk about what I would have done on this paper trade if we knew this was the case. And obviously, you have some indication because after the market closed, they announced the earnings, and you can see the aftermarket trading. So if I go back and I look at the option chains here, so once again, we're dealing with live markets. The trade that we did was we bought the 2,900 strike. We sold the 2,915, which is where the stock hung out at almost all day on Thursday. And then we skipped to 2,930, hence the skip strike. That embeds that credit spread. And now we see it trading, and we bought the 2,945. That added risk to the trade, but allowed us to do it for a net credit of around $1.30 for the account. So we bought this butterfly. In theory, you would say you bought it, but you received a net credit to the account of $130 overall, $130. Okay. So right now, this is trading for a debit of $83. Or 83 cents at the midpoint. Fairly decent market on it, concerning its three options. That means that if we closed out this trade, we put it on for a net credit of $1.30. We could close it out right now if we just fell asleep for the last 3 days. We could close it out for a net credit of 80 cents. You put it on for 80 cents, you close it out for 80 cents. How would we go about doing that? I click this trade button. This is the initial trade. We bought this one, sold two of these ones. I'm sorry about that overall. So now it's a debit of 8 cents. Sold two of these and bought one of these. Okay. So now if I go in and I trade that, and I'm closing, it's not going to be 80 cents. It's going to be 13 cents. I didn't have two in there. Okay. So now to close the trade, we go from buy to open to sell to close, sell to open to buy to close, and then lastly, buy to open would be a sell to close. All right. And now if we look at that position on the marketplace, you would be able to do this for a net credit of 18 cents to the account overall. And so we would put this in at a net credit of 18 cents. And that's how we would close the position. Okay. So after the earnings announcement, I said that I was going to go in and I was going to look at that trade. And I did. On the open, if you would have got out right away, the position had gone against you. The maximum risk was 15 points. Right on the open, if you panicked and closed it, you could have closed it out for about a $12 net debit to the account. That means that you didn't lose the maximum, even though it blew through all the strikes, but there was still a ton of vol premium in it. So you could have saved $3 in theory if the stock would have stayed up over $3,000. You could have saved that $3 by closing it out right away. What I would have done with the trade is I would have went and closed it out and actually rolled it. I would have rolled up and out on the same expiration. You could have done that and moved that whole thing up and basically gave yourself a chip in a chair. So you you would have closed out the skip strike. And at that point in time, you're going to take that loss, and it would have been a fairly decent sized loss because you got blindsided by a stock split announcement, and then rolled and then hoped that that momentum stayed and you still had that chance to make like we were looking forward to start with on the skip strike to begin with. So I would have rolled it up, rolled it out, kept the risk in place, about $1,500 overall, and did that for a net credit. The position that I looked at after the announcement was a 15-point wide trade that was around the 3,000. The strike that we would have bought would have been about the 3,050 strike, selling the 3,055 strike or 65 strike, and then going up and out in time. Okay. So I would have looked to roll it only because it was a huge move on Google. And I couldn't quite see that the momentum would have continued overall. So that would have been my adjustment. I would have closed, took my comeuppance, rolled, and hoped that that momentum went into the Friday marketplace, and I could have maybe got my money back. Because at that point in time, you're just basically, I don't want the cheese anymore. Just let me out of the trap. Very rarely do you see, I shouldn't say very rarely. We talked about it on the show that there was a 10% chance of that happening based off of what the pricing was on the option contract. So the chance wasn't zero. It was a fairly decent probability that it could open above that, go all the way through and open up above our strikes overall. But because it happened, and it happened so aggressively, if you would have act right away on the open, you could have closed out, saved a little bit because there were a lot of time premium in the option contracts, and rolled and hoped. Okay. Now, if you did nothing, the trade was fine. As a matter of fact, if you look at this, if you would have sold, we wanted it to be at 29.15, right in this range on Thursday, you could have closed this out for a net credit of anywhere between $4 and $7 overall, depending on when you did it. You needed time decay in order to do that trade. And as we showed right now, if we look at this trade, if we would have flipped everything, well, right now it's basically being traded for flat because the market is going down overall. But I could close out this trade and still make that net credit of $1.30 from when we put on the initial trade. So very interesting trade from beginning to end. And I'll go back and kind of emphasize it. Well, we have the trade up here. So let's look at the profit and loss graph down here. And so when we put on the initial trade, we had the marketplace trading at, oh gosh, I think it was around 2,800 overall. You see what I have here on my screenshot. One second. So we had the market trading, right around 2,800 when we put on that initial trade. We looked at the 2,900, 2,915. Oh, it was around 27. It was, when I took the screenshot, I think it was around 2,700. The screenshot that I have here was 2728. So it was right within that range. We were looking at an expected move of about 150 points on the open. We almost doubled that at one point in time. And I would have closed out that trade, would have rolled it to the end of the week, would have adjusted the strikes up, gave myself a chance that the underlying could have kept going up, but I would have taken a big loss on the open. If you stuck around and you looked at the trade, the stock actually came and sat right here all day on Thursday. But there was a lot of risk because your risk was all the way from 29.30 all the way out to the expiration at 29.45. This is where a ton of your risk was at. So overall, I don't know what to say. Very interesting trade from beginning to end. The first time that we did a very advanced trade here on the stock play of the day. And we definitely had a learning lesson about the potential of stocks and volatility around earnings. Now, not quite sure why companies decide to have an earnings report, and that happens to be the day that they talk about stock splits to add to volatility in the marketplace. They usually choose that day, and I don't know if it's just laziness because they have the PR all set up or not. But For some reason, that seems to be the time that people like to announce stock splits overall. And stock splits really do nothing to the stock, right? It doesn't change the valuation of the stock. It doesn't change the earnings reports. But overall, stocks have a tendency to go up because it makes it more affordable to buy 100 shares of the underlying stock. All right, so that's going to be it for the stock play of the day. Our first skip strike butterfly, we definitely got our feet wet by looking at the trade. Overall, if you did not get out on the open, the trade actually turned out to be a fairly decent trade in general. And I'm going to recommend, if you want to go and listen to my podcast, the Options Playbook Radio, it gets posted every Thursday morning. We actually looked at Amazon, and we looked at a paper trade in Amazon that was just a flat out butterfly ahead of earnings. So thanks for coming, everyone. Click subscribe, ring the bell, and we'll talk to you this coming up Tuesday for the next stock play of the day.